Which of the following is the key legal principle requiring both parties in an insurance contract to disclose all material facts? A. Subrogation. B. Utmost good faith. C. Indemnity. D. Proximate cause. The correct answer is B. Utmost good faith explanation. The principle of utmost good faith, ubirum affides, requires that both insurer and insured must act honestly and disclose all material facts that would influence the other party's decisions. This principle underpins trust and transparency in insurance relationships. Failure to disclose relevant information can render policy void or result in denied claim. What does the principle of indemnity ensure for the policyholder? A. That the insured always receives double the value of their loss. B. That the insured is returned to their original financial position before the loss. C. That the insurer profits from successful subrogation. D. That the insurer can avoid liability under specific exclusions. The correct answer is B. That the insured is returned to their original financial position before the loss explanation. The indemnity principle ensures the insured is compensated for the actual financial loss, restoring them to the same financial position they were in before the loss occurred. It prohibits any gain or profit from insurance and is fundamental to general insurance contracts. In insurance law, subrogation refers to A. A court's ability to reinterpret a contract. B. The insured's right to cancel the policy at any time. C. The insurer's right to recover from third party after compensating the insured. D. The broker's power to amend the policy wording. The correct answer is C. The insurer's right to recover from third party after compensating the insured. Explanation. Subrogation allows the insurer to recover costs from third parties responsible for the insured loss. Once the insurer pays out, it assumes the right to pursue legal remedies in the insured's name. This prevents the insured from receiving double benefit and helps control claim costs, which principle prevents an insured from receiving more than the actual loss when multiple policies cover the same risk. A. Contribution. B. Consideration. C. Proximate cause. D. Legal capacity. The correct answer is a contribution explanation. The principle of contribution ensures fairness when more than one policy covers the same loss. It prevents the insured from profiting by recovering multiple times. Instead, insurers share liability proportionately based on the amount of coverage each provides. Which of the following is not required for a valid insurance contract under New Zealand law? A. Legal capacity. B. Consideration. C. A written contract document. D. Offer and acceptance. The correct answer is C. A written contract document explanation. While most insurance contracts are in writing for clarity, a written document is not a legal requirement. What is essential is the presence of offer and acceptance consideration. E.g., premium and legal capacity to contract. Verbal agreements can still be legally binding in certain circumstances. Which legislation clarified how insurers should treat material non-disclosure and misrepresentation in New Zealand? A. Financial Service Providers Act 2008. B. Insurance Law Reform Act 1977 and 1985. C. Insurance Prudential Supervision Act 2010. D. Consumer Guarantees Act 1993. The correct answer is B. Insurance Law Reform Acts 1977 and 1985. Explanation. The Insurance Law Reform Acts 1977 and 1985 were enacted to provide fairer treatment for policyholders, especially regarding non-disclosure and misrepresentation. They limit the insurer's ability to avoid claims for innocent mistakes and require that only material non-disclosures can affect claim outcomes. Which principle helps determine the real and effective cause of an insured event? A. Indemnity. B. Contribution. C. Utmost good faith. D. Proximate cause. The correct answer is D. Proximate cause explanation. The proximate cause is the dominant effective cause of the loss in a chain of events. It determines whether the loss is covered by the insurance policy. If a covered peril is the proximate cause, the claim will be valid, even if other contributing factors exist. The Reserve Bank of New Zealand (RBNZ) is responsible for which of the following functions? A. Handling customer complaints. B. Issuing mandatory disclosure documents. C. Licensing insurance brokers. D. Supervising solvency and licensing insurers. The correct answer is D. Supervising solvency and licensing insurers. Explanation. Under the Insurance Prudential Supervision Act 2010, the RBNZ is the prudential regulator for insurers. It is responsible for licensing insurers, enforcing solvency standards, and ensuring that insurers operate soundly to protect policyholders and maintain financial system stability. Under the Financial Service Providers Registration and Dispute Resolution Act 2008, what is the core requirement for insurers? A. They must register as financial service providers and join a dispute resolution scheme. B. They must publish quarterly solvency reports to consumers. C. They must reinsure all risk above $100,000. D. They must only operate through independent brokers. The correct answer is they must register as financial service providers and join a dispute resolution scheme. Explanation. This act mandates that financial service providers, including insurers, must be registered with the Financial Service Providers Register (FPR) and be part of an approved dispute resolution scheme. This enhances transparency and protects consumers by ensuring they have access to fair complaint processes. Which of the following best describes consideration in an insurance contract? A. The agreement between the insurer and reinsurer. B. The payment premium given in exchange for the insurer's promise. C. The value of the insured item. D. The policyholder's future intention to insure. The correct answer is B. The payment premium given in exchange for the insurer's promise. Explanation. In legal terms, consideration refers to the premium paid by the insured, which is exchanged for the insurer's promise to provide coverage under the policy. Without consideration, contract cannot be legally enforceable. Under the Fair Trading Act 1986, businesses must not A. Offer discounts on financial products. B. Use misleading or deceptive conduct in trade. C. Provide refunds on demand. D. Recommend third-party service providers. The correct answer is B. Use misleading or deceptive conduct in trade. Explanation. The Fair Trading Act 1986 prohibits misleading and deceptive conduct by businesses. This includes any false representation or omission that could mislead a consumer. It ensures transparency, honesty, and fairness in the marketing and sale of products and services. Which of the following acts ensures that consumers receive services of an acceptable quality? A. Privacy Act 2020. B. Financial Markets Conduct Act 2013. C. Consumer Guarantees Act 1993. D. Financial Services Legislation Amendment Act 2019. The correct answer is C. Consumer Guarantees Act 1993. Explanation. The Consumer Guarantees Act 1993 ensures that goods and services supplied to consumers meet certain guarantees, including acceptable quality, fitness for purpose, and reasonable timeframes. It gives consumers rights to remedies when these guarantees are not met. The Privacy Act 2020 in New Zealand governs A. The taxation of financial advisors. B. The use and disclosure of personal information. C. Product recall requirements for defective insurance. D. Financial reporting standards. The correct answer is B. The use and disclosure of personal information. Explanation. The Privacy Act 2020 regulates how personal information is collected, stored, used, and disclosed. It introduces the privacy principles, including the right for individuals to access and correct their information, and mandates privacy breach notifications. Which of the following is considered an unfair contract term under New Zealand consumer law? A. A term that allows equal rights of termination for both parties. B. A clearly explained refund policy. C. A term that allows only the insurer to vary terms without agreement. D. A clause that limits coverage for pre-existing conditions. The correct answer is C. A term that allows only the insurer to vary terms without agreement. Explanation. Under the Fair Trading Act, contract terms are considered unfair if they create a significant imbalance in the rights of the parties that are not necessary to protect legitimate interests and would cause detriment if enforced. Allowing only one party to unilaterally vary terms is an example. What is the primary role of Financial Services Complaints Limited (FCL)? A. Licensing financial service providers. B. Prosecuting financial crimes. C. Providing an independent dispute resolution service. D. Auditing insurers for compliance. The correct answer is C. Providing an independent dispute resolution service. Explanation. FCL is an approved external dispute resolution scheme that handles complaints between consumers and financial service providers. It is free for consumers, impartial, and helps resolve disputes without the need for court proceedings. The Financial Services Legislation Amendment Act 2019, FSLI, introduced A. Deregulation of financial markets. B. New licensing requirements for financial advice providers. C. Tax incentives for financial advisors. D. New capital reserve obligations for insurers. The correct answer is B. New licensing requirements for financial advice providers. Explanation. The FSLA reformed New Zealand's financial advice regime, introducing single licensing system for financial advice providers (FAPs) and mandating that all advice must meet standards of competence, conduct, and client care under the Code of Professional Conduct. Under the Code of Professional Conduct for financial advice services, financial advisors must A. Only provide advice to clients they personally know. B. Ensure advice is in the client's best interest. C. Disclose client information to third parties without consent. D. Offer investment products exclusively from one provider. The correct answer is B. Ensure advice is in the client's best interest. Explanation. The Code of Professional Conduct requires financial advisors to act with integrity, care, and diligence, and to ensure their advice is in the client's best interest. Advisors must also disclose conflicts of interest and act ethically and professionally. What is a key disclosure obligation for insurance brokers in New Zealand? A. Disclose only if asked by the client. B. Disclose commission structures and conflicts of interest. C. Disclose the names of their competitors. D. Avoid disclosing policy exclusions. The correct answer is B. Disclose commission structures and conflicts of interest. Explanation. Insurance brokers must fully disclose any commissions, fees, or incentives they receive, along with any conflicts of interest. This promotes transparency and helps clients make informed decisions. The Anti-Money Laundering and Countering Financing of Terrorism Act 2009 requires insurers to A. Accept only cash payments from clients. B. Avoid keeping customer identity records. C. Conduct customer due diligence. CDD. D. File income tax returns for clients. The correct answer is C. Conduct customer due diligence. CDD. Explanation. The Amok Act 2009 mandates that reporting entities such as insurers must carry out customer due diligence to verify the identity of clients and the source of funds. This helps detect and prevent money laundering and terrorist financing. Under AMOCT regulations, a suspicious transaction must be reported. A. Only if it involves more than any D. 100,000. B. When there is reasonable suspicion of illegal activity. C. Only after a conviction. D. At the client's request. The correct answer is B. When there is reasonable suspicion of illegal activity. Explanation. Reporting entities must file a suspicious activity report (SAR) if they reasonably suspect that a transaction may involve money laundering or terrorist financing, regardless of the amount. Prompt reporting is essential to support financial system integrity. Under New Zealand law, insurers must make claim decisions within what kind of time frame? A. As soon as practically reasonable and fair. B. Within 90 days from claim lodgement. C. No later than 14 calendar days. D. Immediately upon receiving the claim. The correct answer is A. As soon as practically reasonable and fair. Explanation. The Fair Insurance Code and other regulatory guidance in New Zealand emphasize that insurers must handle claims fairly and within a reasonable time. While no strict statutory deadline applies to every claim, decisions must not be delayed without valid reason. Failure to do so can trigger regulatory scrutiny or complaints to external dispute resolution schemes, FCL or IFSO. Which of the following is a key feature of external dispute resolution schemes like FCL and IFSO in New Zealand? A. They only resolve disputes involving brokers. B. They are government-run and enforce penalties. C. They are free, independent, and accessible to consumers. D. They provide automatic compensation. The correct answer is C. They are free, independent, and accessible to consumers. Explanation. FCL Financial Services Complaint Facility and IFSO Insurance and Financial Services Ombudsman provide independent, impartial, and free of charge services to resolve disputes between consumers and insurers or financial service providers. These schemes play a critical role in ensuring fair outcomes when internal complaint procedures fail. Which of the following best describes an advisor's conduct obligations under New Zealand's Financial Services Legislation Amendment Act (FSLA)? A. Always act in the best interests of product manufacturers. B. Disclose only product brochures to clients. C. Treat clients fairly and provide appropriate financial advice. D. Sell policies without assessing suitability. The correct answer is C. Treat clients fairly and provide appropriate financial advice explanation. FSLA requires financial advisors and providers to put the client's interests first, treat them fairly, and ensure the advice is suitable based on the client's circumstances. It also requires clear disclosure and competence, knowledge, and skill in delivering financial advice. DS is critical to fair and accurate underwriting. Which professional obligation helps prevent conflicts of interest in general insurance advice? A. Concealing commissions from clients. B. Disclosing all interests and relationships clearly. C. Recommending only affiliated insurer products. D. Avoiding documentation of advice. The correct answer is B. Disclosing all interests and relationships clearly. Explanation. To manage conflicts of interest ethically and legally, insurance professionals must disclose all material relationships, commissions, or interests that could influence their advice. Failing to disclose conflicts breaches both legal obligations and industry codes. What does the Insurance Council of New Zealand's Fair Insurance Code require of its members? A. Offer only low-risk insurance products. B. Provide free coverage during disputes. C. Act with integrity and transparency in dealings with customers. D. Disregard internal complaints if the claim is minor. The correct answer is C. Act with integrity and transparency in dealings with customers. Explanation. The Fair Insurance Code is a self-regulatory code developed by the ICNS that commits its members to high standards of service, integrity, and transparency. This includes handling claims fairly, communicating clearly, and resolving complaints efficiently. What is one of the key responsibilities of insurers when handling customer complaints? A. Wait for the customer to initiate legal proceedings. B. Ignore unresolved complaints after 60 days. C. Ensure the client knows how to access external dispute resolution. D. Require customers to withdraw complaints in writing. The correct answer is C. Ensure the client knows how to access external dispute resolution. Explanation. If an internal complaint remains unresolved after 2 months or reaches a deadlock, insurers must inform the customer of their right to escalate it to an external dispute resolution scheme like FCL, or if so, this ensures transparency and access to justice. What is the purpose of regulatory sandboxes in New Zealand's insurance sector? A. To penalise insurers testing new products. B. To ban untested technologies from entering the market. C. To allow limited trials of innovative products in controlled environment. D. To eliminate regulatory oversight for certain firms. The correct answer is C. To allow limited trials of innovative products in a controlled environment. Explanation. Regulatory sandboxes are designed to encourage technological innovation while maintaining consumer protection. Insurers can test new products or delivery models under close supervision by regulators, helping ensure safe market entry for emerging tools like AI underwriting or digital claims. In the context of general insurance, what does ESC regulation primarily focus on? A. Encouraging exclusive profits. B. Penalizing insurers who issue travel policies. C. Promoting environmental sustainability, social responsibility, and good governance. D. Preventing technology use in claims. The correct answer is C. Promoting environmental sustainability, social responsibility, and good governance. Explanation. ESC environmental, social, governance standards in insurance push providers to manage risks and impacts related to climate change, data use, community impact, and governance practices. These obligations are increasingly monitored by regulators and expected by stakeholders. How do ethical obligations influence record-keeping practices in insurance? A. Records should be destroyed after sales are finalized. B. Only client contact details must be retained. C. Complete and accurate records help demonstrate fair treatment and compliance. D. Record-keeping is optional under most circumstances. The correct answer is C. Complete and accurate records help demonstrate fair treatment and compliance. Explanation. Ethically and legally, insurers and advisors must keep comprehensive records of their interactions, advice, and decision-making processes. This supports transparency, enables dispute resolution, and demonstrates compliance with industry standards and the law. In what way does New Zealand regulation address climate risk in general insurance? A. By limiting cover to government-run schemes only. B. By encouraging insurers to assess and disclose climate-related risks. C. By removing insurer liability for natural disasters. D. By prohibiting climate risk underwriting altogether. The correct answer is B, by encouraging insurers to assess and disclose climate-related risks explanation. Regulators, including the Reserve Bank of New Zealand and the FMA, encourage or require insurers to integrate climate risk into their governance and risk management frameworks. Disclosure requirements also promote transparency around exposure to natural disaster and climate events.